Welcome back, everybody, to the Informed Homebuyer Podcast. I'm Rich Curtis, your host, and I have with me, as always, my co-host, Dave Miller. How you doing, Dave?
I'm good, Rich. Thanks for having me.
If you haven't watched before, of course, I am a realtor, been doing this about 20 years, and Dave is a lender who's been in the business for 25 years. And that's important to today's conversation because we are talking about, is the 3% mortgage interest rate coming back? And I get this question a lot. It's probably like the second most question I get. How's the market? Is now a good time to buy is the most common question. And then what are interest rates doing? Will we ever see 3% again is like the second most asked question I get. So I thought we'd go through it for you today, but we're not just going to go through, do we see 3% coming back? We'll talk about how long would it take to get it back, because the rates go up quick. They don't come down quick. We'll talk about what the economy would have to look like to get it back, and whether that would actually be worth it. Would the squeeze be worth the juice in that event? And we're going to start by putting mortgage interest rates in historical context for you guys. What percentage of the time have we even had these rates? What caused them to begin with? Is this the norm? Is this the exception to the rule? What is the norm? I think it really helps to have some historical perspective when we have these interest rate conversations. So I think we'll start there, Dave, with the history of mortgage rates. What do you think?
Yep, I think that's a great place to start.
All right, let's pull up. I'm going to pull up a chart for y'all. Give me 1 second. We'll pull it up on the screen here. All right. And let's get me and Dave out of your way a little bit here. There we go. All right. Now you can see this chart here. This is a chart from 1971 to the present, showing the average mortgage interest rates in the country through that period. And we'll take you through some different historic periods to show you a few of our takeaways from this chart. Now, this isn't all of recorded mortgage rate history. It only goes back to 1971, but for the vast majority of you watching right now, this will constitute your entire lifetime. I wasn't even born in 1971, although maybe I'll shift the old guy shade to Dave. I bet Dave was alive in 1971.
1970, so I'd be curious to know what happened a year before that. But
you just made it, Dave. You just made it. But as you guys can see, the 5%, the first gradation, the first line down here, that's the 5% mark. 2.5 is the bottom. So 3% falls between the bottom and the top line. So as you look at this 54-year period, you can pretty much see there's just this small chunk over here to the right that falls even below the 5% line. That represents 12 years below 5%, which is 22% of the last 54 years. Someone could get an interest rate even below 5%. So that means, of course, the flip side of that is 78% of the time you were getting loans above 5%. 78% of the years in the last 54 years, you're getting loans above 5%. There's only 10 of these years here that fall in that 3% range. A lot of this is in the fours. There's about 5 through this period here, and we'll talk a little bit in a second about what period that is. And those of you who've been alive long enough already know. And this period here, of course, we all just lived through. There's about 5 years here where you could get interest rate at 3%. So we're talking 10 years out of the last 54 years, or 18% of the time out of the last 54 years, you get a loan in that 3% range. So this is a really, really small portion of the time. So when we think about framing our home buying decisions in terms of whether we're going to see 3% again or not, it's important to know that there was only an 18% of the time window where you could have got that. That is far, far, far the exception rather than the rule. The rule is above 5%, even for the most part above 6%. You can see, here, this is 5, this is 7.5. We have a huge chunk of time. This right here is about 6.5%. We have a huge chunk of time based on where my cursor is through here that you never even got below the 6% range. So 3% is really a rare occurrence historically. And I think you would find that too, Dave. You've been in this business 25 years.
Yeah, 100%. And the one thing I'll bring up, and I've mentioned this to clients before and realtors and people that aren't even in the business, is there's a psychology around interest rates for a consumer. We all experience it, and that psychology, and it's amazing because as you were showing that chart, you were talking about 6%, 7%, maybe higher, below 6% at 5%. What you're representing there, Rich, is the front number of the interest rate. And that is the psychology of interest rates for consumers. And I've been doing this a long time. So if I'm talking to a consumer and I say interest rates are, 6.875, oh, okay. And then a week later it's 7%. Oh my gosh, that's crazy. That's insane. But if I say, okay, you went from 6.875 to 6.75, it's only an eighth of a point movement down versus an eighth of a point movement up. Doesn't phase them too much, right? It's yeah, they want a lower interest rate. Or I'll use a different scenario. We, back in the day when we were below 6%, if your rate was 6 or 6 1/8, some people really wanted to get to 5, and they would pay a lot of money to buy down that rate. I want to be in the 5s, and there was a psychological aspect to it because it was lowering their payment, $25 a month, but they were paying a significant amount of money to get there. But no one pays a significant amount of money to go from 6 1/4 to 6 1/8 because it's the same, right? Like,
Yeah.
and we've had those conversations quite a bit as a realtor. Rich, you want to know where rates are, and if you hear me say 6 1/8, 6 1/4, 6.5, doesn't really phase you. But as soon as I say 5, perking up, right? Things are better, things are great. If I say 7, things are terrible. So there's 8/8 that we work within that window per front numbers of an interest rate. And so that's the psychology of the interest rate. So people, they get caught up in, like I said, that front number, which is obviously we always want the lowest rate possible, but let's not get caught up in the front number. If we're hovering in the 6% and we're on the lower, that's great, right? If we get below 6%, even better. But if we're in the 5s, now all of a sudden they want 4. Like 5.875 is great, but I want to get to 4. I want to get 4.875 seems like the best thing in the world. So I think
it's an important point. And that like 6.875 to 7, right? Like, what are we talking about on a $500,000 house? What did that budget the payment?
$40 a month.
Yeah.
Yep.
So psychologically, it feels like a kick in the guts because you went from 6s to 7s, but because the back number was so high, it actually in the 6s, it actually didn't really matter. $40 a month makes the difference between you buying a house and not buying a house. You probably should be reevaluating whether you're buying a house. But
100%.
Psychologically, emotionally, that front number is what drives the train.
Yeah. And again, I don't want to be a psychologist here or a psychiatrist. Now, fast forward, if you were to show that chart and we were to get into the window after COVID when rates started going up, and I don't want to jump too far ahead, but when we had dropped, and we're going to get there, interest rates dropped into the 3s and high 2s and whatnot. And now they're up to what you just expressed were normal interest rates, right? Average rates, but above 6. We're in the average rate environment. But what happens is we experience loss. We're in denial. Rates were 3%. We want that again so bad.
Yeah.
And I remember as soon as rates went above 6, I told you, and you mentioned this, as people are holding on for hope. I want that 3% again. But the longer we're at 6+, that becomes the norm. It's like when you experience loss. First there's denial, and then you get to the acceptance phase. We are now talking to people and home buyers and people that want to buy that realize rates are in the 6s on average. There's an acceptance around it now because we've had a significant period of time, even if that's a year or two, where rates are above 6.
That's a really good point. Let's go back to that. Let's go back to that chart real quick, and we'll look at those 5 and 10 year windows and see like what our cultural experience has been, over that time frame. So here we've got our chart again, and if we look at it we're in the max here, 1971 to 2025, but if we look at it in the 10-year window, right? Well, now bottom gradation here is 2. Next one up, first line up is 3%. Second line up is 4%, 5%, 6%, 7%, 8% is the peak here. So now when we look at this window that goes from 2015 to 2025, a 10-year window, we're looking at, well, wait a second, the bulk of the chart here is below 6%. We got to 6% just in September of 2022. So now the bulk of that last 10-year period, all but about a year and a half of it, has been below 6%. So if you just came into home buying age, or just hit age of maturity, or the point in your career, regardless of age, where you're finally thinking about buying a home over the last 10 years, then your cultural perception, your benchmarks are set in this 3 and 4% range, because that's what we even better in some cases down here where you're looking in 2020 and we got to the low twos, right? So this is, what Dave's talking about is when you're looking at it in these 10-year periods, these periods where you as a person have begun to pay attention to this. For a lot of the people that would be watching our content right now, looking at buying a home, they started tuning into this stuff in the last 10 years. And so for them, the expectation is these twos and threes. And it's not until you zoom out that you realize, oh, wait a second, that's 10 years out of the last 54 years. That maybe isn't such a realistic expectation,
Right. And I would say for that the folks that from 2022, 2023 on are really that are now in a position or ready to buy a home, they're familiar with the 6% rate. That's the average in the 6th percentile. But what doesn't help is the previous generation home buyer, realtor, mortgage person reminding them, oh, shoot, just 3 years ago or 4 years ago, I had a 2.75 rate. That doesn't feel good. And it's
No.
really not that long ago, but that's the problem with folks that are waiting for that to come back again. Is you're not going to get that. That ship has sailed, at least in the foreseeable future. And we can talk more about what might have to transpire for us to see that again. But be careful what you hope for.
Yeah, because as we look historically, when we look at this, when did we get down for the first time into the threes within this 1971 to 2025 range? Well, if we go back here and we look at 2008, right? That is now, again, I started feeling the effects of the Great Recession in the end of 2005, beginning of 2006, when we're up here at the 6.8% range. Dave and I started working together in 2005. That's how long ago that's been. And I started feeling the market shifting here. But of course, Goldman Sachs, failed somewhere here in 2008. And then you can see, boom, we started dropping. But it still took from 2008 all the way down here until 2012 before we got into the 3% range. So there was a sort of cataclysmic economic event with the big banks failing in 08, 09. And then it took 9, 10, 11, 12, it took 4 more years before we really, the Fed trying to drop the rates to try to stimulate the economy and pull us out of recession. It took 4 years of consistent rate drops to even get into that 3.8% range. And then we bounced around in that 3 to mid 4s range all the way until here when COVID hit, right?
Right.
When COVID hit, what's that?
Yeah. If you were just to go back to that time period too, where rates were lower, that wasn't necessarily, fair market, fair economy rates. That had to do with the Federal Reserve were pumping money in, called quantitative easing. They were buying bonds, mortgage-backed securities to arbitrarily keep interest rates down. It wasn't just simply a supply and demand issue. It wasn't fair market rates. There was influence by the Federal Reserve, to keep to stimulate the economy coming, to help us get through and out of the Great Recession.
Yeah, correct. It was a government response to an economic crisis that artificially created those interest rates. And to some degree, we're always artificially moving the rates around. We really only have 2 levers, print money or raise rates, but this was an extreme manipulation of the economic system to try to pull us out of an extreme recession event. And the cause there, of course, was all the bad loans in that business. And it's not a full real estate history class, so we'll skip over that for now. But it was an extreme event in history that required extreme measures, and that got us down into this range. And then once we got down there, the economy started to recover and just hum along, and it stayed down there. And it stayed down there, in my opinion, far too long. We should have seen, in the 2015 to 2018 range, we really should have seen those rates. We did see them come up a little bit, as you can see, from like 3.5 to 4.5, but we really should have gotten back up into those 5s and 6s normal rates, but we didn't. So when COVID hit, which of course we locked down, over here in March of 2020, right about here. But the world started feeling this late 2019 in other parts of the world in early 2020. So the world economy started to go to heck in a handbasket in response to COVID. And so we saw the rates plummet again and got to even new extreme lows down into those 2% range. So you got about 5 years out of the Great Recession, and you got about 5 years out of the COVID crisis that kept the interest rates low. And that represents the 10 years of the last 54 years, the 18% of the time that we have been at 3% interest rates. Those 10 years, about 5 each, were caused by two of the largest cultural and economic crises in our lifetime. That's what made that happen. And that's what we mean by, is the squeeze really going to be worth the juice? So to answer the question, will we ever see 3% interest rates again? It would be historically poor judgment to say never. If you'd asked me 20 years ago when I got in this business if I'd ever see, Placerville today is 505 to 515 median home price, depending on when you calculate it, over $500,000. If you'd asked me then if the median home price in Placerville would ever be $500,000, I would have laughed at you, and I would have gone on record on TV and said never, right? But age gives you a little more wisdom that never's not really a thing. Things move around, they cycle through, and they come back. And we as a country are still susceptible to financial crises, and that could happen. So Dave, to talk a little bit about the financial crisis in the Great Recession, because that's probably more analogous than COVID to, the type of environment that would have to happen to create a 3% interest rate environment again.
Well, yeah. So what we saw there, Rich, and we talked about it, was a gluttony of mortgage foreclosures and short sales and people, losing their homes. People, because previous to that was, people buying homes that they couldn't afford. You kind of mentioned it: unscrupulous lending, irresponsible lending, irresponsible regulations, so to speak. And so, we saw this rapid buildup of homes being purchased, and everyone that basically had a pulse at that time could qualify for a mortgage, and whether you could afford it or not, that was an afterthought. And so that's really what, like you and I talked about, and that hit us fast and hard. We started seeing investment banks go under. We saw mortgage lenders close. We saw, banks like locally, you may be familiar, Washington Mutual, for example, was a bank that, Chase came in, bought them, bailed them out, maintained their assets. So there was all kinds of craziness going on. All things considered, we recovered pretty quickly from a major crisis. So, and that's because the federal, the government jumped in, and they had the, they wanted to bail out existing homeowners with what they called HARP loans. I don't know if you remember that.
Oh yeah.
Housing and recovery, there was HAMP and HARP. There was different programs. There were, and then the stimulus with the quantitative easing to pump, money into the system to bring interest rates down so that people can start affording to buy, that needed to qualify for a loan. And simultaneously to that is we saw home values crater as much as 50% or more in some areas.
Yeah,
and
Sacramento, where one of the areas we work, was one of the hardest hit in the country, 40 to 60% loss in home value during the Great Recession.
Right. And so when people were in a situation, and people kind of bought all the way down as that started coming down, and then when it got in the bottom, and that's really when you look at like 2010, 11, maybe 12 might have been the low of prices, because everyone wasn't sure when are these going to start coming back and how much, and we would see a little bit of increase, then a dip, and then here we are today. Fast forward to today, where mortgage or home prices are now exceed what we were in the great buildup before the Great Recession. Like probably, I would guess, 150% of the value of what they were then. It's
And
crazy.
that's another thing where, age and perspective, right? Like in 2010, 2012, if you had asked me, are we ever going to see 2005 prices again? I would have thought, no, that was crazy. That was a bubble. That was insane,
Yeah.
right? It peaked between 2005, 2007, depending on what part of the country you're in. And like you said, we've blown those away, by 100, 150%. So that's why the history is so important here.
Yeah.
But
And I think
what's that?
And the difference too between that, and even though we've seen this huge ramp up in value, still the folks that are buying these homes today are qualifying. There's responsible lending. So,
Yes.
we talked about, like, if the crap hits the fan, so to speak, people aren't going to lose their houses like they did back then, or even choose to lose their house. Because back then, so a lot of people didn't have any skin in the game. There was 0% financing, or maybe you put a few bucks down, and if you bought a $300,000 or $400,000 house and you put 5% down, you were 15,000. You're able to walk away, scot free, knowing that your house was underwater by 50 or $100,000. You were motivated to walk away. That's going to,
Yeah,
I really foresee that being much different this time if we see,
100%.
some challenges.
Yeah, even worse than that, you had people who got the pick-a-pay negative amortization loan where they
Yeah,
were owing more on their property each month of ownership, and then they pulled out, or the people who pulled out equity bought a bunch of toys, cars,
yeah,
and boats and all that, and maxed out their debt on the property, and then saw their value drop by 100 grand, and thought, well, I'm never going to see my way out of this. I'll put the keys on the counter and drive away with my truck and boat. And
yeah,
and there's very little consequences to that because they hadn't spent any money on the houses.
yeah,
We are in a wildly different place in that regard. And so that brings up an interesting question, which is what would cause the recession this time? So that recession was caused by the poor lending practices, and then a rapid drop in value that made everybody walk away from the houses. And so we just had cascading waves of foreclosure after foreclosure. This one won't be like that, right? Now,
yeah,
this one is being caused by fiscal policy out of Washington, D.C. This one's because our economy is being pushed around
yeah,
by economic instability, which is a different animal altogether. That could still cause job loss, already has, could still cause people to lose their homes. All that's going to happen on a slower, more measured pace. It'll be a slower march to the bottom this time without these waves of foreclosure pushing us around if we get there to
right.
recession. But the answer to what would bring about 3% again is major economic crisis. Would you agree?
Yeah, and I really thought in the last couple of years, and especially after COVID, that with the next kind of shoe to drop was, everyone was told, or at least in the business was told, commercial lending, commercial real estate. A little obviously a different animal than residential, but with people working from home and companies allowing people to work from home, we have this gluttony of vacant properties, commercial properties. We thought that was going to have this really major impact on the economy. Now folks are being kind of forced. There's, you got to return to the office. So companies are, re-inhabiting those spaces, or those spaces are being reconditioned for other purposes. And whether that's, we saw spaces or big, businesses that were repurposed for shipping purposes, for
Oh yeah,
lost
like
train of
yeah,
thought.
like pop up Amazon distribution centers
Distribution
in
centers
old
and
Class A
yes,
office space. Yeah,
yeah, and so we've kind of morphed and been able to kind of navigate through that, and so that would
yeah,
have been the next one that I would have thought would have been the issue. And now with these tariffs and what we're seeing now, I would suspect that only so much pain is going to be allowed to be experienced before we pivot. Um,
Yeah, that's the hope. I think what hasn't been calculated in there. So we were talking offline here about there's a pretty strong narrative in the media right now, true or false, you be the judge, but that the Trump administration is intentionally breaking the economy, intentionally messing with the tariffs to try to push the interest rates back down and get them back down quicker, with the idea that they sort of take their foot off the gas just in time to miss hitting the wall, kind of deal,
right.
or put their foot on the brakes just in time to miss hitting the wall. I think what hasn't been calculated in there is that he's kind of smacked the hornet's nest around the rest of the world. And so the other places that are putting tariffs on us and messing with us financially now in response, they are not. They're not on his team. They don't care about taking their foot off the gas before the American economy craters. And so we have some follow on effects that are going to keep going even after he stops smacking the hornet's nest, if he does. And that could still push us into recession. That is the big fear out there in the marketplace, and none of the people saying that can reliably even say that. Financial predictions more than a month out are pretty hard to do. Right? Like, what is it? Weathermen and economists are the only two people who can be wrong 80% of the time and keep their jobs, right?
Right. And to that point is, people are, I think they throw around the word recession a little more loosely than they used to, because it used to really stimulate a lot of fear in people. And the one thing I learned in paying attention to this is we've always been in, or not always, historically, there have been what's called, mini recessions, but we didn't know it till after the fact, till we came out of it, right? Like they
Yeah,
could point back historically and look at the data and say, okay, we were in a, quasi or mini recession at this point in time.
yeah.
So I think that's now we talk about it more openly. We have a little bit of history with it from the Great Recession, and anything that we experience now wouldn't be that bad. So we're not freaking out like we would have freaked out back then.
Yeah, that helps too. Yeah, having lived through the big one, but
Yeah.
that's kind of like the big Loma Prieta earthquake. I lived in the Bay Area for that one. After that 7.1 earthquake, all the little 3s and 4s were like, that's
Yeah.
nothing.
Child's play. Yeah.
Yeah. But so it would be a major economic recession or major economic event that would push us back down into the 3s. And if that happened, for some of you who have stable recession-proof employment, you may be able to refi, you may be able to take advantage of this. It'll be a bonus. But for the vast majority of Americans, it'd be a really, really bad thing. It would cause a lot of job loss, a lot of economic, financial, month-to-month instability and problems for people. And if you're a seller, a lot of the buyers for your home won't have a job anymore. So it doesn't matter if they can get a 3% interest rate, no job, no loan, no buy house, right?
Hmm.
And for a lot of the buyers, no job, no loan, no buy house. So we sort of lose on both ends when these things happen. So to my mind, with 20 years of business perspective and nearly half a century of life perspective, I'm not really pulling for the 3s to come back, because if they do, the rest of what comes with it will be ugly, and it won't be good for any of us in
Yeah.
that event.
Yeah. And the take I get in talking to folks, Rich, and people in the industry, people that aren't in the industry, if we saw that front number become a 5, we are really going to get some traction, right? Assuming that home
Everybody will be
prices,
happy. Yeah.
yes, and that's assuming that home prices don't escalate, on an exponential basis, that they,
Correct.
maybe they appreciate along with inflationary numbers,
Yeah.
and mortgage interest rates get a front number of 5, and even low 6s. Again, that's not going to help the psychology of the home buyer that wants that 5. But if we see low 6s, 6 and an 8, that's going to seem really nice, right? And then, we
Yeah.
got to get to 6 before we're going to get to high 5s. And it's potentially we can get there without a catastrophic event that's, we start seeing things recover. We see inflation being checked, the Fed's lower the Fed fund rate. We get, they're talking about 2 more potential rate cuts this year, but don't expect 5% range in 2025. We're most
Yeah.
likely, if that's going to happen, probably going to be 2026 and beyond.
And again, when we go back to if we go back to that chart, let me pull that up, grab that one here again. If we go back to this thing and we look at how long does it take, to get to that 3%, remember it took from, Lehman Brothers and Goldman Sachs, going out of business in 2008, till all the way down to 2012 before we started to see those 3%. So that's just a drop from, where were we at an 8, around 6% probably. Yeah, 6.5% down to mid to high 3s. Took 4 years. So even it's going to take a while before any of this tariff business, all hits the economy in such a way that it starts to really break things. And then from that point, it's going to be a slow march down. So, a worst case scenario, by the end of the year, we start to see recessionary forces. It still could be several more years before you're seeing anything in those 3% range. So we said we wanted to pay off both questions. Will we see 3% again? And how long would it take? And in my opinion, even in the worst, most catastrophic financial situation, it would be at least a couple of years more before we get anywhere near something like that. And we'd have to see a lot of pain between now and then. And a more reasonable or likely expectation is that we're going to stay in the 6s, in the mid 6s, all the way through this year. And we have to wait and see. I'm not even willing to hang my hat on next year, given the instability and sort of chaos of the fiscal
Yeah.
policy right now. But I can say with relative certainty that we're probably not going to see anything below the 6s in 2025. And that if your home buying decision is predicated on getting back to the 3s, you are going to wait until houses are so much more expensive than you can afford before you'll ever get there.
Right. And to that point, Rich, is if you buy a home today, you bought a home 2 years ago, and rates tend to trend down. It gives me a flashback to the early 2000s when rates were, 6 or 7%, and people would buy a home or they had owned a home, then rates would drop a percentage point or so, they would refinance.
Yeah.
Fast forward 2 or 3 years after that, maybe they go down another half a point or a point, people refinance again. So if you bought your home and, in the last couple of years and you have a 6% rate and rates trend down, maybe you have a 7% rate, there's going to be relief for you if you could refinance in the low sixes.
Yeah.
And then at some point, if they get into the five, so that's the beauty is, and we always talk about this, you have a known quantity. When you buy a home and you have a 30-year fixed mortgage, your principal and interest are locked for the life of the loan. That's not going to get worse, but it has the opportunity to get better if you're in a position and have the ability to refinance if some things hold true in the future, which, of all the folks that I've helped with mortgage purchase financing, I would say 90% of those folks I've been able to help with a refinance at some point in time.
Yeah.
I just can't speak to the last couple of years because anyone that bought in the or refinanced sub 4 probably isn't refinancing again. But if you bought in the sixes or, and the other beauty of that, you've got a lot of equity and maybe you have consumer debt and maybe you're just trading your interest rate for a slightly lower, but you're paying off a ton of consumer debt or student loans, or you want to refinance your house and maybe pull money out to do a renovation that you can enjoy, or that you're going to, whatever that, we're going to start seeing that, come back around.
Yeah. And I think the real takeaway there is if you can afford the house at this interest rate now, waiting for 3% is a bad deal because the price appreciation is going to blow you out of the water way quicker than the interest rate will help you get better. And so that kind of brings you back to, well, if interest rate isn't the decision-making factor here, what is? And for that, you can watch last week's episode where we kind of go through the 5 fundamentals of what makes you a good qualified buyer in any market at any point in history. And if you've got these 5 things, you're good to go and you can afford it at this interest rate, then go ahead and buy and then bring it down if or when you can. But if you don't have those 5 things in place, interest rate doesn't really matter. And so I encourage people to start to shift the mindset out of this interest rate focused mindset and into what makes me a good, solid, financially stable buyer who can make good decisions for my family. Because as you can see by looking at that chart, over the course of the last 54 years, we are in average to pretty darn good interest rate territory historically. So it comes down more to home price, taking advantage of home appreciation, and just having your own personal financial fundamentals in line so that you can keep that house regardless of what comes in the economy.
Yep. Well said.
All right. I think we will wrap it there, guys. Thank you so much, as always, for making it to the end with us. I hope this answers your question about when are 3% come back? Are they coming back? What would cause it? And would it be worth it? And the answer is they might come back. It would take a while and probably ain't worth it if they do. You probably won't like what's going on in the rest of the world if that happens. So thanks for being with us. As always, thanks for making it to the end with us. And we'll see you on the next one. I'm Rich Curtis.
I'm Dave Miller. Thank you.
Bye, guys.